In December 2000,
Enron was worth $74 billion. 1 year later, it was bankrupt. Thousands lost their jobs, billions vanished, and the world witnessed one of the most audacious corporate frauds in history. This is the story of Enron and the lie that fooled Wall Street. Enron was once the darling of American business, a high-flying energy company that promised to revolutionize the way electricity and natural gas were traded. It was praised for innovation, admired for growth, and trusted by investors. But behind the scenes, Enron was building a house of cards, a complex web of accounting tricks, shell companies, and executive deception that would eventually collapse, taking down not just a company, but shaking the foundations of corporate America. Founded in 1985 through a merger of two natural gas companies, Enron quickly grew into a major player in the energy sector.
under CEO Ken Lay,
It expanded aggressively, embracing deregulation and pioneering new ways to trade energy as a commodity. By the late 1990s, Enron was more than an energy company, it was a symbol of innovation. It launched Enron Online, the first web-based energy trading platform. It entered broadband, water, and even weather derivatives. The company's stock soared. Analysts praised its strategy. Fortune named it America's most innovative company 6 years in a row. But the numbers behind the praise were fiction. Enron's executives weren't just managing a business, they were manufacturing earnings. To hide debt and inflate profits, they created hundreds of shell companies, known as Special Purpose Entities, or SPEs. These entities allowed Enron to move liabilities off its balance sheet and report inflated earnings. The company also used a technique called mark-to-market accounting. Instead of reporting actual profits, Enron estimated future earnings from long-term contracts and booked them as current revenue. This meant Enron could sign a 10-year deal, guess how much it might earn, and report that number immediately, even if the money wouldn't arrive for a decade or ever. It was legal, but it was misleading, and it created a financial illusion that fooled investors, analysts, and regulators. If stories like this help you understand the hidden mechanics behind billion-dollar collapses, support the channel. Like the video, share it with someone who loves business deep dives, and subscribe to Business Failures. Your engagement helps bring these investigations to life. Ken Lay was the public face of Enron. A former economist with deep political connections, Lay positioned Enron as a leader in deregulated markets. He cultivated relationships in Washington, lobbied for favorable policies, and built a board filled with powerful allies. But Lay's leadership was hands-off. He delegated financial strategy to others, especially Jeffrey Skilling. Skilling joined Enron in 1990 and quickly rose through the ranks. He was brilliant, aggressive, and obsessed with innovation. Skilling championed mark-to-market accounting and pushed Enron into new markets, many of which were untested and unstable. He created a culture of performance at all costs. Employees were ranked and fired ruthlessly. Risk was celebrated. Skepticism was punished. Skilling believed Enron could become the world's largest company, and he was willing to bend reality to make it happen. Andrew Fastow, Enron's CFO, was the architect of its financial deception. He created and managed the SPEs that hid debt and inflated earnings. Fastow built entities like LJM and Chuco, shell companies that allowed Enron to move liabilities off its books while still controlling the assets. He also personally profited from these deals, earning millions in fees while deceiving shareholders. Fastow's actions were unethical, deceptive, and ultimately criminal. But for years, they were hidden behind layers of complexity and corporate silence. Enron's culture rewarded loyalty and punished dissent. Employees who questioned the numbers were ignored or fired. The board of directors failed to challenge management. Auditors at Arthur Andersen signed off on the financials. Wall Street analysts continued to recommend the stock. The media praised the company. Everyone wanted Enron to succeed, and that collective desire blinded them to the truth. In August 2001, Sharon Watkins, a vice president at Enron, wrote a memo to Ken Lay, warning that the company could implode in a wave of accounting scandals. Her memo was ignored, but it marked the beginning of the end. Soon, journalists, analysts, and regulators began asking questions. The numbers didn't add up. The debt was too high. The earnings were too smooth. The illusion was cracking. In October 2001, the SEC launched an investigation into Enron's accounting practices. The company admitted it had overstated earnings by nearly $600 million. It revealed hidden liabilities. It restated financials. The stock plummeted. Creditors panicked. Investors fled. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. It was the largest corporate bankruptcy in U.S. history at the time. Thousands of employees lost their jobs and retirement savings. Investors lost billions. Arthur Andersen, one of the world's largest accounting firms, was indicted and eventually dissolved. The collapse wasn't just financial, it was personal. Employees who had trusted the company were left with nothing. Pension funds were wiped out, careers were destroyed, and the trust in corporate America was shaken. Ken Lay and Jeffrey Skilling were indicted in 2004. Lay was convicted but died before sentencing. Skilling was sentenced to 24 years in prison. Fastow served 6 years. The trials revealed the depth of the deception and the failure of oversight. In response to Enron and other scandals, Congress passed the Sarbanes-Oxley Act in 2002. The law imposed stricter rules on corporate governance, financial reporting, and auditor independence. It created new protections for whistleblowers and increased penalties for fraud. Enron's collapse changed the way companies are audited, how boards operate, and how investors evaluate risk. It exposed the dangers of unchecked ambition, weak oversight, and financial engineering. And it reminded the world that even the most admired companies can fall. Enron's story is a warning, a lesson in how greed, deception, and silence can destroy a company, devastate lives, and shake an entire economy. It's a reminder that transparency matters, that leadership must be accountable, and that numbers, no matter how impressive, must be real. What do you think was the biggest takeaway from the Enron scandal? Was it the failure of leadership, the breakdown of oversight, or the blind faith of investors? Share your thoughts in the comments and subscribe to Business Failures for more deep dives into the companies that shaped and shattered the business world.